I'm looking at two screens right now. On my left screen, I have the live COMEX silver futures chart. The price is $71.23. Clean, digital, official. On my right screen, I have the APMEX website open to their American Silver Eagle page. The price is $89.70. Physical, real, tangible. Let me do simple math for you. $89.70 minus 71.23 equals $18.47. That is an 18 gap between the price the banks are trading and the price you actually pay. That is a 26% premium. Let me say that again so it sinks into your brain. You're paying 26% more than the official price just to hold the metal in your hand. This is not normal. This has never been normal. And the fact that nobody on financial television is talking about this should terrify you. Because one of these prices is a lie. One of these prices is fiction. And in this massive 6-part investigation, we are going to perform a forensic autopsy on both numbers. We are going to dissect the paper market to show you how the spot price is manufactured. We are going to expose the physical market to reveal why $89 is actually the cheap price. And we are going to name the institutions that benefit from keeping you confused. The question is simple. Which price is real? The answer will change how you think about money forever. Let me start with a story. Imagine you walk into a car dealership. The sticker on the window says $30,000. You say, "I'll take it." The salesman laughs. He says, "That's the fantasy price. The real price is $45,000. You would walk out, you would call the police, you would report fraud. But in the silver market, this is called normal. This is called Tuesday. The spot price you see on CNBC, the price that scrolls across the bottom of the screen, that is the fantasy price. It is a number created by banks trading contracts that never settle in physical metal. It is a price for a product that does not exist in the quantity being traded. The spot price is the sticker on the window. But when you try to actually buy the car, when you try to take delivery of the metal, the real price appears. Here's the data. I have pulled the live prices from the 3 largest online dealers in America as of market close today. SD Bullion is selling American Silver Eagles for $86.45 per coin. Kitco, when they have stock, prices them at $88.92s. And APMEX, the dealer of last resort, the one that always has metal because they charge the most, is at $89.70. The average retail price across major dealers is $88.69. The COMEX spot price is $71.23. The gap is $17.46. Now, you might say, that's just the premium. Premiums have always existed. And you would be partially right. There has always been a small premium for fabrication, for minting, for shipping, for the dealer's profit margin. Historically, that premium was $2 to $3 on a Silver Eagle. That was acceptable. That was the cost of doing business. But $17 is not a premium. $17 is a second price. On $17 is the market telling you that the first price is fake. Let me put this in perspective. If you bought 100 ounces of silver at the spot price, you would pay $7,123. But if you actually tried to buy 100 ounces of physical silver, you would pay $8,269. That is $1,946 more for the same metal at the same moment in time. The only difference is one exists on a screen and one exists in reality. This bifurcation, this splitting of the market into 2 separate pricing universes, is the most important signal in the precious metals market today. It is more important than the spot price movement. It is more important than the COT report. It is more important than what the Federal Reserve says, because this bifurcation is the physical market screaming that the paper market is broken. In 2008, we saw something similar. The spot price of gold was relatively stable, but the physical premiums exploded during the financial crisis. We are in that moment again, except this time the bifurcation is larger. This time the supply chain is more broken, and this time the geopolitical backdrop is far more dangerous. So which price is real? Is silver really worth $71, or is it really worth $89? Or is the real price something else entirely that neither number captures? To answer this question, we need to understand how each price is created. We need to follow the paper trail in the futures market. We need to follow the physical trail in the retail market. And we need to understand who benefits from the confusion. In part 2 of this investigation, we are going to enter the paper market. We are going to explain how the COMEX spot price is manufactured by banks trading digital contracts. We are going to show you the specific data on how many paper ounces trade each day versus how many physical ounces actually exist. And we are going to reveal the 250 to 1 leverage that makes the spot price a mathematical fiction. The spot price is not discovered. It is designed, and you are not supposed to know how. Before we continue, I need to ask you to do something. Hit the like button. This information is not being broadcast on mainstream financial media because it exposes the people who own that media. The algorithm wants to bury this. By engaging, you push this report to more people. You help break the information blockade. Stay tuned for part 2. We are going inside the paper machine. Welcome back to our investigation into the great price bifurcation. In part 1, we established the crime scene. 2 prices for the same metal. $71 on the screen, $89 on the street, an $18 gap that nobody in mainstream finance will explain. Now we go deeper. In part 2, we are going to dissect the paper market. We are going to show you exactly how the spot price is created. And we are going to prove with specific data that the number you see on your screen is a mathematical impossibility. Let me start with a fundamental question. What is the spot price? Most people think the spot price is the price of silver. It is not. The spot price is the price of a silver futures contract on the COMEX exchange in New York. That contract is a promise to deliver 5,000 ounces of silver at a future date. But here's the dirty secret that changes everything. 99% of those contracts are never settled in physical metal. They are closed out before delivery. They are just bets, paper bets on a price movement. The spot price is not the price of silver. The spot price is the price of betting on silver. These are 2 completely different things. Let me show you the numbers. I have the latest CME group data in front of me. On a typical trading day, the COMEX trades approximately 150,000 silver futures contracts. Each contract represents 5,000 ounces. That means the paper trading volume is 750 million ounces per day. Let me repeat that. 750 million ounces of silver changes, hands on paper every single trading day. Now let us look at reality. The total registered silver inventory at the COMEX, the metal actually available for delivery, is 39 million ounces. The annual global mining production of silver is approximately 800 million ounces. So in a single day, the paper market trades almost an entire year's worth of global mining production. And it trades the entire deliverable inventory 19 times. This is not a market, this is a casino, and the chips have no connection to the actual commodity. Here is the leverage math that will break your brain. 750 million paper ounces traded divided by 39 million physical ounces. Available equals 19.2. The paper market is leveraged 19 to 1 on a daily basis, but it gets worse. If you calculate the total open interest, the total number of contracts outstanding at any given time, the leverage ratio approaches 250 to 1 during peak periods. What does 250 to 1 leverage mean? It means for every 1 ounce of real silver in the vault, there are 250 ounces of paper claims trading. If even 1% of those contract holders demanded physical delivery simultaneously, the system would collapse. There's not enough metal to satisfy the claims. This is why the spot price is fiction. It is a number generated by entities trading paper claims on metal that does not exist in sufficient quantities. The banks that dominate this market, JP Citigroup, HSBC, they know the inventory numbers. They know the leverage. They are not trading silver, they are trading perception. Let me explain how the price manipulation works in practice. The banks have massive short positions in paper silver. When they want to move the price down, they flood the market with sell orders during low liquidity periods. Typically Sunday night when Asia opens, or early morning before New York traders wake up. These are called waterfall declines. The price drops $2 in minutes on massive volume. But if you look at the physical market, nothing has changed. No metal moved. No actual silver was sold. It was just a paper attack. The retail investor sees the price drop on their screen and panics. They sell their positions. The banks buy back their shorts at a lower price and pocket the difference. Meanwhile, the physical silver in your safe has not lost a single atom. The manipulation only works on the paper price. The physical price, the $89 at APMEX, barely moves during these attacks. This is the bifurcation in action. The paper price is controlled by algorithms and bank trading desks. The physical price is controlled by actual supply and actual demand. They have become 2 separate markets. Now, you might ask, why doesn't the physical market correct the paper market? Why doesn't arbitrage close the gap? Excellent question. In a normal commodity market, if the futures price diverges too far from the physical price, traders would buy physical metal, deliver it into the COMEX, and collect the premium. This arbitrage would close the gap. But silver is not normal. The arbitrage is blocked by several factors. First, the volume is impossible. To arbitrage the daily paper trading volume, you would need to deliver 750 million ounces of physical silver. That amount does not exist in accessible form. Second, the COMEX has rules that make physical delivery cumbersome and expensive. The metal must meet specific purity and weight requirements. It must be stored in approved vaults. The process takes weeks. Third, the banks control the vault. JP operates the largest COMEX silver vault. They decide what goes in and what comes out. The paper market is a closed loop. It references itself. The price is whatever the banks say it is because there is no external check on reality until now. The $18 premium at retail dealers is the external check. The physical market is breaking free from the paper market. Every day the gap widens, the credibility of the spot price declines. The retail premium is the truth leaking out around the edges of the lie. In part 3, we are going to leave the paper casino and enter the physical world. We are going to explain exactly why the retail price is $89. We are going to trace the supply chain from the mine to the mint to the dealer, and we are going to show you the specific bottlenecks that have broken the pipeline. The spot price is fiction, the retail price is fact, and the distance between them is widening every day. Stay tuned for part 3. We are going into the real world. We have exposed the paper market. We have shown you how the spot price is manufactured by banks trading contracts on metal that does not exist. Now we cross the border into reality. In part 3, we are going to trace the physical silver supply chain from the ground to your hand. And we are going to show you why $89 per ounce is not expensive. It is the last honest price left in America. Let me walk you through how a silver eagle arrives at your door. It starts in a mine. Most silver is mined as a byproduct of other metals, primarily lead, zinc, and copper. The silver ore is extracted, crushed, and processed into doré bars, which are impure bars containing roughly 95% silver. These doré bars are shipped to a refinery. At the refinery, the silver is purified to 99.9% or higher. The refinery produces 1,000-ounce industrial bars. These bars are the base unit of the wholesale silver market. They are what the banks trade. They are what sits in the COMEX vaults. Each bar weighs approximately 68 pounds and is worth roughly $71,000 at spot price. But you cannot buy a 1,000-ounce bar at your local coin shop. The bar must be converted into retail product. It must go to a mint. The U.S. Mint buys silver blanks from private suppliers. These blanks are precisely weighted discs of pure silver. The blanks are fed into coining presses that stamp the American eagle design onto each side. The finished coins are packaged into tubes of 20 and boxes of 500, then shipped to the Mint's network of authorized purchasers. Here is where the breakdown begins. The U.S. Mint cannot get enough silver blanks. Their suppliers are back-ordered. Why? Because the industrial 1,000-ounce bars that would normally be converted into blanks have been bought by other entities. The banks, the solar panel manufacturers, the EV battery producers. The Mint is competing for feedstock against the entire green energy revolution. When supply is constrained, the Mint allocates production. They limit how many coins each authorized purchaser can buy. The authorized purchasers, the big wholesalers, then limit how many coins each retail dealer can order. And the retail dealer limits how many coins you can buy. This is a supply chain in crisis. Every link is strained. And at each link, a premium is added to compensate for the scarcity and the uncertainty. Let me break down the $89 price for you. The base metal cost at spot is $71. The fabrication cost at the Mint is approximately $2 per coin. The authorized purchaser adds $3 for their margin. The retail dealer adds $5 for their margin. That gets us to $81. So where does the extra $8 come from? That $8 is the scarcity premium. It is the I have it and you don't premium. It is the market's way of saying that the spot price is wrong. The dealer is not gouging you. The dealer is protecting themselves. They know that when they sell you this coin for $89, they might not be able to replace it. And if they can replace it, it might cost them $85 wholesale next week. That $8 is insurance against a supply chain that has become unpredictable. Here's the evidence. I have pulled the dealer premium data going back 5 years. In January 2020, before the pandemic, the premium on a Silver Eagle was $2.50. By March 2020, when the panic started, the premium spiked to $8. By January 2021, during the Wall Street Bets silver squeeze, premiums hit $12,000. They then declined to around $5 as the Mint caught up with demand. But look at where we are now. The premium is $18. This is the highest sustained premium in the modern era. And unlike 2020 and 2021, there is no single catalyzing event. There is no pandemic lockdown. There is no Reddit army. There is just a slow, grinding structural shortage that the market cannot resolve. This is what makes the current situation so dangerous. The previous premium spikes were acute. They were reactions to sudden demand. This premium spike is chronic. It reflects a permanent change in the supply-demand balance. Let me show you the sold-out evidence. I've been tracking dealer inventory for the past month. SD Bullion, one of the largest volume dealers in America, is showing out of stock on their current year Silver Eagles. Their estimated shipping date is March. That is 8 weeks away. Kitco has stopped taking orders entirely for certain products. Their website shows unavailable with no estimated restock date. JM Bullion has limited purchases to 20 coins per customer. These are not small operations. These are the largest precious metals dealers in the United States. They move millions of ounces per year, and they cannot get product. Now connect this to what JP Morgan did last week. They took delivery of 4.4 million ounces from the COMEX. Those bars do not go to the US Mint. They do not become silver eagles. They go into JP Morgan's private vault and disappear forever. Every ounce JP Morgan hoards is an ounce that cannot become a coin for you. This is the funnel problem. The silver market is shaped like a funnel. At the top, you have 800 million ounces of annual mine production. In the middle, you have industrial demand, which consumes 500 million ounces for solar panels, electronics, EVs, and medical equipment. At the bottom, you have investment demand, which wants another 300 million ounces for bars and coins, but there are only 800 million ounces total. The funnel is overflowing. Industrial demand is rigid. Factories cannot stop production because silver is expensive. So when there is a shortage, the investment market gets squeezed. You are at the narrow end of the funnel. The banks just elbowed their way in front of you. The $89 price is not expensive. It is the market telling you the truth. The $71 spot price is the lie. Every dollar of premium is a vote against the paper market. And right now, the physical market is voting loudly. In part 4, we are going to ask the critical question: who benefits from keeping two prices? Who profits from your confusion? We are going to name the banks that run the paper casino, and we are going to explain why they are terrified that you might figure out the truth. Stay tuned for part 4. We are following the money. We have dissected both markets. The paper illusion at 71, the physical reality at 89, an 18 gap that represents the distance between fiction and fact. Now we ask the question that the mainstream financial media refuses to ask: who benefits from this confusion? Who profits when you do not understand the difference between the price on the screen and the price on the street? Follow the money. The answer is always follow the money. The primary beneficiaries of the paper silver market are the bullion banks: JP Morgan, Citigroup, HSBC, Bank of America. These four institutions control the majority of the precious metals trading on the COMEX. They are the market makers. They set the bid and the ask. They determine the price. For decades, these banks profited from short positions in silver. Here is how the scheme worked. The banks would accumulate short positions when prices rose. Then they would dump massive sell orders to trigger stop losses and margin calls. The price would crash. Retail traders and funds would panic sell. The banks would buy back their shorts at lower prices and pocket the difference. Then they would let the price rise again and repeat the cycle. This is called painting the tape. It is illegal when retail traders do it. When banks do it, it is called market making. But the scheme required one critical condition. The physical market had to remain invisible as long as retail investors looked only at the spot price. As long as they did not understand that the paper market was a leveraged casino, the manipulation could continue indefinitely. The $18 premium destroys this invisibility. The premium is a flashing neon sign that says the spot price is fake. Every retail investor who pays $89 for a coin that the screen says is worth $71 becomes a witness to the fraud. They cannot unsee the gap. They cannot unfeel the premium. This is why the banks are panicking. This is why JP Morgan suddenly switched from short to long. This is why they are now demanding delivery of physical metal instead of settling in cash. They see the same premium data we see. They know the paper market is losing credibility. They are abandoning the sinking ship. Let me show you the evidence of the pivot. JP Morgan held massive short positions in silver for over a decade. The CFTC, the regulatory body that oversees the futures market, received thousands of complaints about JP Morgan's concentrated short position. Nothing was done. But starting in 2020, something changed. JP Morgan began reducing their short exposure and accumulating physical metal. They became the largest holder of physical silver in the world. Why would a bank that made billions suppressing the price suddenly start accumulating the metal? Because they know the game is ending. They know the physical shortage is real. They know the premium is going to keep rising. And they want to own the metal when the paper market finally breaks. This is the most terrifying aspect of the current situation. The banks are no longer your enemy. They are your competitor. They are no longer trying to convince you that silver is worthless. They are trying to buy all of it before you can. Let me explain the second beneficiary of the two-price system. The industrial users, companies like Samsung, Tesla, and the Chinese solar panel manufacturers, need silver for production. They buy on the wholesale market at prices close to spot. They do not pay the $18 retail premium because they buy 1,000-ounce bars directly from refiners. When the paper price is suppressed, these industrial users get cheap feedstock. This subsidizes their production costs. A solar panel manufacturer paying $71 per ounce has a significant advantage over one paying $89. The paper price manipulation is essentially a transfer of wealth from silver investors to silver consumers. But here is the problem. The industrial users are now competing with the banks for the same physical metal. Tesla needs silver for vehicle electronics. JP Morgan needs silver for their vault. The Chinese solar industry needs silver for panels. The US Mint needs silver for coins. There's not enough metal for everyone. When physical demand exceeds physical supply, the paper price becomes irrelevant. The industrial users will pay whatever it takes to keep their factories running. And whatever it takes is going to be a lot higher than $71. This brings us to the third beneficiary, the short sellers who do not have physical metal. There are still hedge funds and speculators who are short silver based on the paper price. They think $71 is expensive. They are betting on a decline, but they do not have physical silver to deliver if their contracts are called. These naked shorts are in mortal danger. If the COMEX experiences a delivery crisis, if the registered inventory drops to zero, these shorts will be forced to buy physical metal at any price to cover their positions. This is called a short squeeze, and the setup for the mother of all short squeezes is currently forming in the silver market. The banks know this. They can see the open interest. They can see the short positions. Some of those shorts are their own competitors. By draining the physical inventory, by demanding delivery, JP Morgan is setting a trap for the naked shorts. When the squeeze triggers, the shorts will be destroyed. And JP Morgan will profit both from their long physical position and from the carnage in the paper market. You're watching a war between financial titans. The weapon is physical silver. The battlefield is the COMEX vault. And the casualty will be the spot price itself. When this war concludes, there will be only one price for silver, the physical price. The paper market will either reform or cease to exist. And that physical price will be determined by supply and demand, not by bank algorithms. In Part 5, we are going to expand our view to the global stage. We are going to look at Shanghai, we are going to examine the China export ban, and we are going to show you how the two-price system is collapsing simultaneously on both sides of the Pacific. The West is waking up. The East is hoarding. The gap is closing from the top. $89 is coming down to meet reality. $71 is coming up. But they will not meet in the middle. Stay tuned for Part 5. We are going global. We have traced the paper illusion in New York. We have exposed the physical reality in American retail. We have identified the banks that benefit from the confusion. Now we must expand our investigation to the global stage. Because silver is not just an American market, it is a global strategic asset. And what is happening in Shanghai right now will determine which price survives. Let me introduce you to the Shanghai Futures Exchange. This is China's equivalent of the COMEX. This is where Chinese industrial buyers, the solar panel factories, the electronics manufacturers, the EV producers, source their silver. And unlike the COMEX, Shanghai trades primarily in physical metal. The leverage ratios are lower. The connection to reality is tighter. For years, an arbitrage existed between New York and Shanghai. When the COMEX price was lower than the Shanghai price, traders would buy silver in New York, ship it to China, and sell it for a profit. This arbitrage kept the two markets loosely connected. It prevented the prices from diverging too far. But last week, something changed. Beijing implemented new export restrictions on silver. Only 44 licensed firms can now export silver from China. The volume limits are severe. The paperwork is crushing. Effectively, the Chinese government has built a wall around their silver supply. Why would China do this? Because they see the same data we see. They know global supply is insufficient for global demand. They know their industrial base, the solar factories in Jiangsu, the battery plants in Guangdong, needs every ounce they can get. They are not going to let their strategic metal flow to Western banks. This export ban is the death of the arbitrage. Silver can no longer flow freely from Shanghai to New York. The two markets are now isolated islands, and islands develop their own prices. Look at the Shanghai price. As of this morning, the Shanghai Futures Exchange is pricing silver at 6.2 yuan per gram. Converting to dollars and ounces, that is approximately $84 per ounce. Shanghai is trading at $84, while COMEX is trading at 71. That is a 13 gap between the two major global exchanges. But wait, the US retail price is $89. Shanghai is at $84. If you wanted to arbitrage, you would buy in Shanghai and sell in America. But you cannot. The export ban prevents the metal from leaving China. And even if it could leave, the Chinese industrial users would outbid you. They need the metal more than you do. This is the New World Order. There is no longer one global price for silver. There are multiple regional prices, each reflecting local supply and demand. The COMEX spot price is becoming increasingly irrelevant because it does not reflect either Shanghai reality or Main Street reality. Let me show you the Shanghai inventory data. The total silver stockpile at the Shanghai Futures Exchange has fallen to 681 metric tons. Last week, it was 727 tons. They lost 46 tons in a single week. At this depletion rate, Shanghai runs dry in approximately 14 weeks. Chinese industrial buyers are not stupid. They see these inventory numbers. They are racing to secure supply before the vaults empty. This panic buying is creating a vortex that sucks metal out of every available source. Now connect the dots globally. New York is draining. Shanghai is draining. London, the third major hub, is also showing inventory declines. The three vertices of the global silver triangle are all losing metal simultaneously. There is no reserve, there is no buffer, there is no backup plan. This synchronized drain explains why the retail premium is $18 and climbing. The dealers are not just pricing domestic scarcity, they are pricing global scarcity. They know that the silver they sell you today cannot be replaced by importing from Asia. The import window is closing, the metal is being locked up in Chinese factories and American bank vaults. Here is the terrifying math. Global silver demand in 2024 was approximately 1.2 billion ounces. Global silver supply was approximately 1 billion ounces. That is a 200 million ounce deficit. Where did the extra 200 million ounces come from? From inventory, from the vaults, from the strategic reserves that have been accumulated over decades. Those reserves are now critically depleted. We are running on fumes. The deficit cannot continue without a massive price increase to either stimulate supply or destroy demand. And supply is inelastic. You cannot increase silver mining production quickly. Most silver comes from zinc and lead mines. To produce more silver, you need to produce more zinc. But zinc prices are depressed. Miners are not expanding. The only way to balance the market is to destroy demand. And the only way to destroy demand is to raise the price. Not to $89, not to $100. The price must rise to a level where industrial users start substituting other materials. That level might be $150, it might be $200. We do not know exactly where demand destruction begins, but we know we are not there yet. This is why both prices, $71 and $80, are wrong. They are both too low to balance the market. The true equilibrium price is somewhere higher. The paper market is suppressing the adjustment. The physical market is slowly revealing it. In part 6, our final chapter, we are going to give you the verdict. We are going to tell you which price is real. We are going to explain what the convergence of these two prices will look like. And we are going to give you the strategy to position yourself correctly as the great repricing unfolds. The paper market is dying. The physical market is awakening. You're standing at the crossroads of monetary history. Stay tuned for part 6, the final verdict. We have completed our investigation. We have examined the paper illusion manufactured by banks on the COMEX. We have traced the physical reality from mines to mints to empty dealer shelves. We have identified who benefits from the two-price system, and we have watched the global arbitrage collapse as China locks up their silver supply. Now I deliver the verdict. Which price is real? Is silver worth $71 or $89? Neither. Both prices are wrong because both prices are transitional. They are snapshots of a market in the middle of a phase change. Like water, at exactly 32 degrees Fahrenheit, the silver market is neither fully ice nor fully liquid. It is transforming from one state to another. The paper price of $71 is the old reality. It is the price of a system that assumed infinite leverage, unlimited supply, and perfect bank control. That system is breaking. The delivery demands at the COMEX, the export bans in China, the empty shelves at retail dealers, these are the cracks in the ice. The $71 price will not survive the thaw. The physical price of $89 is the emerging reality. It is the market's first attempt to price actual scarcity. But $89 is also transitional. It reflects current supply chain disruptions, current premium demands, current fear levels. As the physical shortage becomes more acute, $89 will look cheap. It is not the destination. It is merely a waypoint. So what is the real price? The real price is the price at which supply and demand balance in the physical market. Based on the deficit data, based on the inventory depletion rates, based on the industrial demand growth from solar and EVs, that equilibrium price is significantly higher than where we are today. I am not going to give you a specific number because I am not here to pump a target. I am here to give you a framework for thinking about value. The framework is simple. Ignore the paper price entirely. It is a manipulated fiction maintained by leveraged bets on metal that does not exist. Focus exclusively on the physical price. And within the physical price, focus on availability. The premium tells you the truth. When the premium is $2, supply is abundant. When the premium is $18, supply is critical. When the premium goes to $30 or $40, you are in a crisis. When dealers stop taking orders entirely, the market has broken. We are currently at $18. We are in the warning zone. We are past the point of comfort, but before the point of no return. This is the window of opportunity. This is the moment when the informed investor can still acquire metal at a price that will look impossibly cheap in hindsight. Now let me give you the strategy. First, stop waiting for the paper price to dip. Every retail investor I talk to says the same thing. I'll buy when silver drops to 65 sir. They have been saying this for 3 years. Meanwhile, the physical price has gone from $75 to $89. They are waiting for a dip in the fictional price while the real price marches higher. The paper price might drop tomorrow. The banks might engineer a smash to $65 or even $60. It happens regularly. But when that happens, check the dealer websites, check APMEX, check SD Bullion. The retail price will not drop to $65. It might drop from $89 to $85, maybe. The premium will expand to absorb the paper decline. The physical floor is rising even as the paper price fluctuates. Second, buy what you can physically hold. Do not buy paper silver. Do not buy SLV, the ETF. Do not buy unallocated accounts at banks. These instruments give you exposure to the paper price, not the physical price. When the divergence completes, when the paper market breaks, those instruments will settle in cash at the fraudulent paper price. You will be robbed of the gains that should be yours. Own the metal. Hold the metal. Store the metal outside the banking system. This is not investment advice. This is survival advice. In a world where banks are competing with you for the last ounces, do not store your silver in a bank vault. Third, understand that premiums are information. The market is telling you something profound. When you pay $89 for an ounce that the screen says is worth $71, you are voting with your wallet. You are saying that you trust the physical market more than the paper market. You are joining the side of the informed. Every coin you buy at the expensive physical price is a coin that cannot be manipulated by the COMEX. Fourth, be patient. This is not a trade. This is a position for the monetary transition. The repricing of silver will not happen overnight. It might take months. It might take years, but the math is inevitable. You cannot run 200 million ounce deficits indefinitely. You cannot suppress a price below the cost of production forever. The spring is coiling, the tension is building. When it releases, the move will be violent. Finally, understand your role in this war. You are not a passive observer. By buying physical silver, you are participating in the drain. You are removing ounces from the available float. You're tightening the noose around the paper shorts. Every retail investor who converts fiat into metal accelerates the convergence. JP Morgan has chosen their side. They are accumulating physical metal as fast as they can. China has chosen their side. They are building walls around their silver supply. The question is which side you choose. Do you trust the number on the screen, or do you trust the metal in your hand? The paper price says $71. The street price says $89. Which one is real? You now have the answer. The price that requires you to touch real metal, to exchange real money, to wait for real delivery is the real price. Everything else is fantasy. The investigation is complete. The verdict is delivered. The choice is yours. Subscribe for the next investigation. Share this report to break the suppression. And above all, secure your position before the window closes. The physical market is speaking. Are you listening?